Hey, welcome back. My name's Dave Dubeau, and today we're going to be talking about capital stacks in real estate investing. What are they? How do they work? Why do you need them? When do you need them? And what are the different kinds of capital that you might be using? And where do you get it from? That's what we're talking about here today. What exactly is a capital stack when it comes to real estate investing? Well, it's the different kinds of money you might need to do different aspects of a real estate deal, all the way from acquiring a property to renovating a property to holding on to the property long term. There might be different kinds of money from different sources that you need to do that. And that is what a capital stack is, stacking one kind of capital, one kind of money on top of another to do the entire deal. So what are the different components of a capital stack? Well, there could be all sorts of different parts of this. There could be equity capital, there could be mezzanine financing, there could be senior debt and junior debt, and all these different kinds of things that come together to create a capital stack. So here's a simple example of what a capital stack might look like in a smaller deal. Let's say you're doing a BRRRR. You're buying a property, you're renovating that property, you're renting it out, and then you're refinancing that property, and then you're repeating the whole process. So to do that kind of a deal, you might need some money for the down payment. So that could be one form of capital. Perhaps you're coming up with that capital yourself. Perhaps you've got an investor or a joint venture partner coming up with that capital. And chances are that's going to be some of the equity capital in that deal. So that's one component. Now, you're also going to need money to renovate that property. So that could be coming in the form of a renovation loan. That could be a separate investor loaning you money for a fixed interest rate. That could be part of the whole loan that you're getting from a traditional lender for that property. There's different ways that can come in. So you've got your initial down payment money. That could be one part of the capital. The other part could be the renovation costs. That could be coming from something else. And then there could be the main part of the purchase price of that property, the money that a traditional lender is loaning you in the form of a mortgage. It could be a hard money loan, but again, that's tied into ownership of the property. They are registered on title to secure their funds for that property. So different kinds of capital for that deal. And then let's say you do that property, you do that deal, you get it all renovated, and then you refinance that property and you pull out your initial investment plus some of the rest of it, and you pay off those different people. So perhaps you pay yourself back for your initial money for the down payment, you pay off the person or the entity that loaned you the money for the renovations, and you pay off the hard money loan that you got to purchase the bulk of that property. And then you've got a nice, clean, traditional type mortgage with an A lender at the end of it all. So what are the big advantages of a capital stack? Well, you're able to use different kinds of money for different components of your deal, and it gives you more flexibility. So just like that example of doing the simple BRRRR with a single family home, perhaps you're bringing some of the money to the table, perhaps a joint venture partner is bringing some money to the table, perhaps an investor is loaning you some money for the renovations, perhaps a bank is coming in and financing the rest, or a hard money lender. It gives you more flexibility. You don't have to come up with all of the cash to purchase the property and renovate the property. You've got different kinds of capital for each component involved. So what are some of the risks or disadvantages to having a capital stack? Well, it complicates your life a little bit, right? So if you've got different investors with different amounts of money invested in your deal and getting different security and different returns, you have to manage all of that and make sure that everybody gets paid properly and on time. And if you don't, that can start a whole series of events that can be very, very painful and costly for you. So you want to make sure that if you're doing a capital stack, that you've really crunched your numbers ahead of time, that you're very conservative about what your expectations are so that you can cover all of those different loans that you're paying out on, and that you keep the time frame tight so that you don't get extended, because typically some of this money is very, very expensive. Other parts of the money might not be that expensive, or you don't have to pay out right away. So for example, if you've got joint venture partners on board, they only start getting paid once the property is profitable. But if you've got a hard money lender on board, they're getting their payment every single week or every single month, and you always have to keep that stuff in mind when setting this up. So what are the different factors that you have to take into account for getting a capital stack? Well, it really depends a lot on two big things. Number one, the deal itself. The bigger the deal and the more that's involved with that property, typically that's where you're going to be seeing a lot of this kind of capital stack situation happening, especially if you're doing development type deals. If you're building a large condominium or a large multifamily or a large commercial property from the ground up, typically that's where you're going to be looking at a whole bunch of different kinds of financing all throughout the entire project. If you're doing something simpler, then it's a lot easier, that's for sure. So it depends on the size of the deal. And then the other thing that really comes into play is the credit worthiness of the actual deal maker or the general partners in that whole deal. So those are the two things that are really going to come into play. Now, raising private capital really comes into play with doing capital stacks because it's one of the main ways that real estate investors are coming up with the earnest money to do a deal, coming up with the down payment money to do deals, coming up with the renovation costs to do deals. Raising private capital is a big part of all of this. But again, I highly recommend the smaller the deal, the fewer investor partners you have on board, the simpler that you keep it for yourself. But once you start scaling up and doing bigger and bigger deals, then you might have to be looking at doing this kind of a capital stack type situation. Now, speaking of raising private capital, if that's what you're interested in doing, then I've got the perfect resource for you. It's my book, Money Partner Formula. This is a proven methodology that I've done myself and that hundreds, actually at this point, thousands of other real estate investors just like you have used over the years as well to raise their first 6 figures in a matter of weeks and even 7 figures in a matter of months, even if you're starting from scratch and you've never raised any capital before. So you can get a free copy. Just click on the description and the link below, or you can go to investorattractionbook.com. So whether you're a new capital raiser or you're somebody that's been doing this for a while and you're looking for some different tricks and tips and ideas, this is a great resource for you. Go ahead and grab a copy today.